say the future of the bull market and if it's stalling out or not. So let's ask Solus Alternative Asset Management's Dan Greenhaus. Dan, it's great to have you here with me, and you're looking at sort of three keys as we go into 2026. Yeah, the calendar turned, but you think other things are fairly intact. Walk us through.
Yeah, you were talking to Steve Weiss on the halftime show, and I think his points were entirely accurate. The calendar turns, but that doesn't mean that your investment thesis changes in any way. Obviously, there might be tax or regulatory adjustments, but practically speaking, the three things that have been driving markets are likely to continue doing so. And very quickly, what's that? It's the AI trade, which doesn't appear to be slowing down in any meaningful way. I know we're worried about it, but no company has told me anything other than demand exceeds supply. It's the Fed, still accommodative, maybe not as much as some people hoped, but they're more than likely not going to be raising rates, and they're beginning to provide liquidity to the market. And then third, you have pretty healthy GDP growth, not the best ever, but healthy enough, call it 2.5%, which should drive top line growth. And with a little bit of margin expansion, probably call it 10 to 15% earnings growth in the year. So those three things are your tailwinds for much of last year and likely much of this year as well.
So let's drill down to those a little bit more. So the AI story, front and center, but it's not going to be just enough for a company to throw out AI in a conference call and hope they get a bump from it. What do investors really want and need to see from that AI trade to continue the acceleration?
I don't actually think a lot of companies really did that. Just said, listen, I know that at one point there were some like a tea companies that were changing their names to Bitcoin, and they got a big pop. But on the AI story, I've made this point repeatedly. I'll do it again. I know a lot of people are saying that this is the year we need to see the adoption, we need to see the productivity, we need to see the earnings growth. I mean, maybe, but I don't know that. I know right now, again, on the investment side of things, CapEx is still enormous, hundreds of billions of dollars. Demand still exceeds supply. It's benefiting, as you mentioned, Micron, NVIDIA, Broadcom, on down through the infrastructure, the industrial type names that are helping this build out. And again, I don't know why all of a sudden, it'll happen. I don't have any evidence for why all of a sudden with the calendar turn, I now need to see Procter & Gamble have AI productivity and efficiency gains. Right. Maybe, but I don't know.
Fair enough. And then consumer resilience. That, when I was trying to think about 2025, was one of the key themes to me that admittedly surprised me, because if you would have said retail stocks or consumer tilted stocks would have ended the way they did, albeit less than some other names, but still, after the April 2nd announcement, pretty amazing what the consumer has done in the face of all this pressure.
I think that's exactly right. At the highest level, you can look at the credit card companies, American Express, Capital One, MasterCard, Visa, obviously. They're all close to or near record highs. That captures, obviously, all spending. But at the specific stock level, you've got a couple of things working for you. Clearly, the low-income consumer, we know this for 2 years. I don't need to repeat it. The low-income consumer is challenged. But to make the point of how difficult investing is, well, what if I told you the low-income consumer was challenged? We better short Dollar Tree and Five Below. And those companies are experiencing a tremendous rally. And in the case of Five Below, which was dealing with shrink and a lot of other problems, they've figured that out. Margins are benefiting, so that stock is up a whole lot. You also have turnarounds in Ulta and Deckers and Kohl's, names you're obviously very familiar with. And then at the highest level, you have companies that are just resonating. Brand resonation is doing quite well with Tapestry and Coach and Ralph Lauren. Aspirational, higher income, but still doing exceedingly well. So yes, you have some trouble in the space, but on balance, the consumer has been incredibly resilient. Not surprising to me, I might add, because I think the jobs market, not great, but not terrible either. And as inflation has come down, real income growth has been positive, and I think that's been a powerful support for the consumer in general.